There's a huge mistake that I've seen a lot of 401k investors make, and it has the possibility to not only impact the performance of your 401k, but it also has the ability to add a tremendous amount of stress to your retirement planning efforts. If you're new to our channel, I'm Johnathan Rankin. I'm the founder of Theorem Wealth Management, a retirement planning focused firm to help you maximize your retirement. In this video, I'm going to talk about a huge mistake that I've seen 401k investors make, and make sure you stick around to the end where I share 5 retirement investing tips that you don't want to miss. Now, as soon as you set up your 401k, one of the first things that you'll do is choose how the money that you save is going to be invested. How large your 401k will eventually get is based on 3 factors: how much you save, how many years you save for, and what you invest the money in. Now, when people start out investing, they often think of scenes from movies like Wall Street where there are traders on the floor buying and selling, or nowadays they think of having multiple screens with charts all over the place to determine what to invest in. And a lot of people think that's what you need to do in order to be a successful investor. But the reality is that's not needed at all. In fact, being that active just might prevent you from reaching your retirement potential. There's one common mistake that I've seen a lot of investors make when investing for retirement, and it comes down to how often they're checking and updating their retirement account investments. As you save and invest for retirement, it is important to make sure that your investments are on track to meet your goals, but how often should you be checking and updating your retirement accounts? Well, the short answer is it depends. In theory, the frequency in which you check and update your investments should depend on your personal investment strategy, your risk tolerance, and your overall financial goals. But this leaves out one of the biggest factors of retirement investing: your investing behavior. The closer you get to retirement and the larger your portfolio gets, the less tolerant of risk people become. And in highly volatile markets like we've seen over the past year, it's easy to become worried about your investment strategy. And when you combine volatility with the fear of losing money, bad things tend to happen. In down markets, there are typically 3 camps of retirement investors: the ones who check it every day, the ones who don't check it at all, and the ones who don't change their process. And depending on your investment behavior, there really is no wrong camp to be in. Of course, not checking your accounts at all makes it really difficult to know if you're on track to your long-term goals. But if you're working with an advisor who's monitoring it for you, then that might just make the path to retirement a lot less stressful. On the other hand, if you're a disciplined investor with a long-term view, there's no problem with checking your account daily. When it becomes a bad thing is when it's not just checking the account balance daily, and it becomes trying to make a bunch of changes. In down markets, there's this common thought to just move things to a safe place and wait for things to get better. The problem with that is that by definition, a better market would be a higher market. And I've never seen financial success defined as selling low and then buying higher. One of the biggest dangers of market timing is the potential to miss out on potential gains. According to a study by Morningstar, investors who attempted to time the market by moving in and out of stocks missed out on an average of 3.5% per year in returns compared to those who just remained invested. This is because by attempting to time the market, investors might miss out on the potential for investments to recover and provide long-term growth. In fact, according to JP Morgan, the average investor underperformed almost every asset class from 2002 through 2021, and they attribute this to the average investor constantly rotating out of underperformers before they recover and rotating into stronger performers before they decline. Market timing can also lead to emotional decision making, which can be detrimental to long-term success. In fact, research by the Journal of Financial Planning found that investors who engage in market timing are more likely to make hasty decisions based on short-term market fluctuations rather than sticking to a long-term investment plan. And when it comes to predicting where the market's going to be, even the biggest firms on Wall Street can't do it. In fact, at the beginning of last year, the beginning of 2022, the year-end predictions for the S&P 500 were 5,300 for BMO Harris, 5,200 for Wells Fargo, and 5,100 for Goldman Sachs. And where did the market close? At 38.54. In fact, since 1992, only 2% of active funds actually outperformed the S&P 500. There's a big difference between market timing and making regular changes to your investment portfolio. If you're going in on a regular basis and you're rebalancing, or you're making adjustments to your portfolio based on your long-term outlook of the market, that's completely fine. That's normal. Where it becomes troublesome is when you take your whole portfolio and shift it into one investment because of a down day or a gut feeling on how the market's going to react to certain news. Build a routine around your retirement investing. How will you set up your investment portfolio? How often are you going to review it and make changes? And stick to that in good and bad markets. Investing in volatile markets can be stressful, and that's why it's important to create a strategy that not only fits your long-term goals and risk tolerance, but also your investing behavior, which leads me to the 5 retirement investing tips to remember. Number 1, more risk does not mean more reward. Number 2, if your investment portfolio is based on how you think the market will perform this next year, you're setting yourself up for failure. Number 3, long-term investment success is not flashy. In fact, it's really boring. Number 4, diversification is more than the number of funds that you invest in. It's about what those funds actually invest your money in. Number 5, every bear market in history has ended and eventually turned into a bull market. And it's really important to remember that in bear markets. If you wonder if you're on track to your retirement, make sure you check out this video where I discuss how much you actually need to retire. I'll see you there.